Usually when we talk about a business surviving or failing, there's this expectation of visible drama.
Oh, yeah. A massive scandal or something.
Right. A factory burning down, a competitor launching a billion-dollar product. It's loud, it makes headlines, and, it feels like that's where the real stakes are.
It's very cinematic. We look for the big, obvious explosions because they're easy to point to and say, yeah, that's why they went under.
But step into the world of managerial accounting, and that whole dramatic explosion theory is completely wrong. We're looking at a landscape where the life and death of a business is decided silently, right, in the background by fractions of a percent.
It's the absolute definition of invisible leverage. The quiet gears turning beneath the surface that ultimately decide if the doors stay open next month.
And that is exactly what cost volume profit analysis maps out, which is the focus of our deep dive today.
Yeah, CVP analysis.
Right, CVP. We are diving into a stack of source material from IGNU on CVP today to extract a shortcut for understanding how businesses actually plan for profit.
And how they survive economic chaos, honestly.
Exactly, how they make those do-or-die pricing decisions. And I know it's easy to dismiss this as just dry accounting, but the source quotes Horngren saying this is inherently appealing to management.
Oh, absolutely.
Because it gives a sweeping overview of the whole planning process.
Yeah.
Right. It shows exactly how costs behave when the pressure is really on.
It really does. Today's deep dive is going to give you, the listener, a real aha moment about why a tiny, seemingly harmless tweak in price can completely double a company's profits.
Or wipe them out entirely overnight.
Right, yeah, or wipe them out. It's a completely different way of looking at the mechanics of business, especially those short-run decisions managers face daily.
Okay, let's unpack this. Because to understand how a minor tweak in price can be that destructive, we need to look at the tools management actually has.
The levers they can pull.
Yeah, the levers. If you're trying to mix the perfect track for a healthy profit, you essentially have 4 dials on your soundboard. You've got your selling price, your sales volume, your variable costs, and your fixed costs.
And what's really critical to understand right out of the gate is that you don't have equal control over all 4 of those dials.
Right, they aren't all the same.
No, not at all. The selling price, for instance, is highly constrained. Management has very little real control there because, well, prices are largely dictated by external market forces.
Like competitors.
Exactly. If a major competitor suddenly drops their price, your hand is often forced to match them. It doesn't really matter what your internal spreadsheets say.
You can't just crank the price dial to the max and expect your customers to stick around.
Right. Costs are much more controllable internally. You can, negotiate with suppliers or find cheaper office space. But even among costs, in the short run, the largest single variable affecting your bottom line is the volume of output, like how much you're actually producing and selling.
But here's the trick with that DJ soundboard analogy. If you push the volume fader up, it automatically pulls the variable cost fader up right along with it.
Yeah, they're tied together.
You can't move one without the other.
Yeah.
Every extra unit you sell means more materials, more direct labor, more shipping.
Exactly.
So volume alone doesn't guarantee a good mix, which means just turning up the volume isn't the magic fix everyone assumes it is.
It really defies the standard business intuition that selling more is always the answer.
Right.
The source material actually maps out an illustration 9.1, that shows just how dangerous that assumption can be.
That went through that specific scenario. But let's avoid getting bogged down in the ledger numbers and just look at the ratios, right?
Sure. So the baseline is this. Imagine a normal volume of 200,000 units at a 2 rupee selling price.
Okay, so that's 400,000 rupees in total sales.
Exactly. And the variable expenses are 1 rupee per unit, which means exactly half of every dollar or rupee goes straight to variable costs like raw materials.
And the other half goes toward paying down their fixed costs, which the source says are 160,000 rupees.
Right. So in their normal baseline state, after all that is paid, they're left with a net profit of 40,000 rupees. A modest, but, healthy profit.
Okay, a very standard setup. Now, what happens if management gets nervous about a new competitor and decides to drop their selling price by just 10% to attract more volume?
They think, we'll lower the price a bit, get more customers, make it up in volume.
Right, but this is the part that shifted my entire perspective. Because the raw materials, the variable costs, they still cost exactly the same. So that 10% price cut comes entirely out of the profit margin. In this scenario, a mere 10% drop in price doesn't just lower the profit.
It wipes it out completely.
Yes, it drops the net profit to exactly 0. The company's suddenly just breaking even. 100% of the profit gone from a 10% price cut.
What's fascinating here is the asymmetry. The margin was tight enough that giving away 10% on the price tag erased the entire bottom line.
Wow.
But if we look at turning the dial the other way, increasing the price by 10%, the opposite effect happens. Assuming they manage to sell the same amount of product, that 10% increase drops straight to the bottom line.
So it effectively doubles their total profit.
Yes. A 100% profit increase from just a 10% price bump. Profit goes up to 80,000 rupees.
And if they tried to achieve that same doubling of profit just by turning up the volume dial, like keep the price the same but just push the team to sell more units,
they would have to increase their sales volume by a full 20% to get that same 100% profit bump.
Wait, really?
Yeah. The math proves that a price increase explodes profits exponentially faster than a volume increase. A 20% price increase would actually explode profits by 200%.
That is wild.
Furthermore, increasing your prices, even if it causes a decrease in how many units you ultimately sell, frequently results in higher overall profits than lowering prices to push more volume.
I have to pause on that, because capitalism is practically built on the idea of moving product, right? We celebrate the companies that ship the most units, the stores with the highest foot traffic.
Sure, we do.
So wait, why does price have such a disproportionately massive superpower compared to volume? Shouldn't selling more units always be the ultimate goal?
To answer that, we have to pull back the curtain on the underlying mechanics of CVP. Specifically, we have to separate total revenue from what accountants call marginal income, or contribution.
Contribution, okay.
Yeah. When you sell a product, the revenue doesn't just magically become profit. First, it has to pay for the materials to make that specific product. Whatever is left over after paying for the variable costs, the raw materials and direct labor, that is your contribution.
So it's called contribution because it literally contributes to paying off the fixed costs first, the rent, the insurance, the equipment.
Exactly.
And only after the landlord is completely paid off does that remaining money contribute to the owner's profit.
Precisely. And this dictates a company's PV ratio, or profit volume ratio. It's basically the variable cost ratio deducted from one, or unity.
Okay, so in our example, the variable cost is 50%, so the PV ratio is also 50%.
Right. Just think of the PV ratio as how much of every dollar stays in the house. If variable costs take 50 cents, your PV ratio is the other 50 cents. That 50 cents goes to the rent and eventually to profit.
So going back to the pricing superpower, when you cut your price, you are shrinking the amount of money that stays in the house per unit. But your fixed costs haven't changed at all.
Not one bit.
You still owe the exact same amount of rent at the end of the month. So you have to sell a vastly greater number of units just to generate the same total contribution to cover that rent.
Which is why dropping prices to chase volume can quickly become a mathematical death spiral. You're working harder, producing more, stressing your workforce just to tread water.
Just to hit that break-even point where total costs equal total revenues.
Exactly. But I want to clarify a massive misconception here. CVP analysis is very often called break-even analysis in the business world.
Right, you hear that term constantly.
But it's overly restrictive to look at it that way. If you map this out on a profit graph, the break-even point is just one specific stop on the transit from fixed costs to target profit. No business aims to just break even.
So what does this all mean for the listener? Well, if dropping prices is a death spiral, how do managers know when they're getting too close to the edge?
That is where the margin of safety comes in.
Right. Understanding the margin of safety is basically like knowing how much gas is left in your tank after the gauge hits E.
Right.
It's the exact amount your sales can drop before you start bleeding money.
It's the buffer zone between your planned sales and the break-even point. If you plan to sell $1 million worth of product and your break-even is at $800,000, your margin of safety is $200,000.
You can afford to lose a fifth of your planned sales before you really have to panic.
Exactly. It's your cushion.
But how much cushion you actually have in that tank heavily depends on how your specific company is built. And this transitions us nicely, because the source material maps out two completely different business models side by side.
Yeah, Company A and Company B.
Right, to show how their cost structures change the game.
So if we connect this to the bigger picture, these two companies are fundamentally opposed in their architecture. Company A operates with a very high ratio of fixed costs to total costs.
Okay, so think of a heavily automated manufacturing plant, or maybe a massive software company. You have huge upfront costs, right? Server farms, robotics, highly paid engineers.
Right. But producing one more unit of software or having a robot stamp out one more widget costs almost nothing in variable terms.
So high fixed costs, very low variable costs. This makes me think of Company A as a massive freight train.
A freight train, I like that.
Yeah, it takes an incredible amount of energy, a huge amount of sales, just to get the thing moving. Because they have to cover those massive fixed costs, their break-even point is exceptionally high.
They have to sell a lot of volume before they see a single dime of profit.
But once that freight train crosses the break-even line, its momentum is unstoppable. Because their variable costs are so low, almost every dollar of new sales goes straight to the bottom line. The profit angle on their graph is incredibly steep.
It skyrockets quickly. But there's a flip side to that momentum. If the economy takes a downturn and sales drop, a heavy freight train is very hard to stop.
Oh, true.
They don't have the luxury of just laying off a few hourly workers or buying less raw material because their costs are fixed. The rent on the factory is due whether they are running at full capacity or sitting empty.
So the losses mount just as steeply as profits do.
Exactly. It is a very high-risk, high-reward structure.
Now contrast that with Company B, which has a very low ratio of fixed costs to total costs. Think a consulting firm, a landscaping business, maybe a catering company. They have very little equipment to maintain. Maybe they rent a tiny office space. But every time they make a sale, they have to buy fresh ingredients or pay hourly wages to consultants.
So low fixed costs, but very high variable costs, which completely changes their strategic reality.
Right. If Company A is a freight train, Company B is a nimble bicycle.
Nice.
It's incredibly easy to start. They have a very low break-even point because their fixed costs are tiny. They can start turning a profit almost on day one. It's great for navigating tight spaces and surviving tough economic times.
Because they have a much larger margin of safety, meaning they can weather difficult business spells without having to shut down. If a recession hits, they simply buy less material and cut hourly shifts.
But the bicycle has a capped top speed.
Right.
Because their variable costs are so high, even when they sell a massive amount of product, huge chunk of that revenue goes right back out the door to pay for the labor and materials. Their profit line grows, but it grows very slowly compared to the freight train.
And this is exactly why managers rely on CVP analysis. A pricing strategy that works perfectly for the bicycle might completely derail the freight train. The high fixed cost company can't hazard a strategy that risks even a small drop in volume.
Because it could ruin them.
Exactly. While the bicycle company can afford to experiment a bit more because their margin of safety protects them.
Here's where it gets really interesting, though. Looking at the way these concepts are modeled, the perfectly straight lines on the profit graphs in the source, I have to push back a little on the reality of it all.
Oh, I know where you're going with this.
Yeah, to draw these neat lines and calculate an exact break-even point, accountants have to make some pretty bold assumptions about how the real world operates.
It's true. To construct the profit graph, the mathematical model requires a perfect world set of conditions. We have to assume that variable costs are perfectly constant per unit. We assume fixed costs remain totally static. We assume selling prices don't fluctuate at all, and that factor prices, like wages and materials, are completely frozen in time.
But aren't accountants just putting blinders on? I mean, we know for a fact that none of those things are true. Rent goes up, employees get overtime pay, suppliers raise prices. The real world is messy.
Oh, it's very messy.
So if we know these assumptions are technically false, why do we trust the CVP model with the life or death of a business?
It's a valid critique. But the defense lies in a concept called the relevant range.
Relevant range.
Yeah. While assuming linear, perfectly straight cost patterns isn't strictly accurate across an infinite timeline or a massive scale, within a specific planned window of normal business activity, say, producing between 50,000 and 70,000 units, those straight lines are a reasonable reflection of reality.
So it's like a map. A map isn't the actual territory. It doesn't show every single pothole or newly planted tree, but it's accurate enough to get you to your destination.
Exactly. And getting perfectly accurate, nonlinear data in real life is simply too expensive and difficult to justify the cost. The cost-benefit analysis of that data collection just doesn't make sense. Managers accept the slight inaccuracy of the linear assumptions because it provides a functional tool.
And to even get the data to plug into that map, you have to do a bit of mathematical untangling. Because in the real world, costs rarely arrive neatly labeled as fixed or variable.
Oh, no. Most of them are mixed.
Right. How do we segregate those mixed costs? The source material highlights this with the Rivali Limited example. Think of plotting direct labor hours against electricity charges. There's a base charge just to be connected to the grid that's fixed, and then a charge for the actual power used, which is variable.
So before you can use CVP analysis, you have to perform cost segregation. You can use a visual scatter diagram where you plot a year's worth of bills on a graph and eyeball a straight line through the dots to find the fixed element.
But eyeballing a line isn't exactly precise.
No, which is why the source highlights the least squares method. It uses the regression formula y equals a plus bx. Instead of eyeballing, least squares mathematically calculates the exact average of those messy real-world bills.
Okay, so going back to the Rivali Limited example from the text, they crunched the labor hours and electricity bills through this least squares method.
Right, and they were able to pinpoint the underlying fixed electricity cost at exactly 416 rupees.
And the variable rate was precisely 4.4 pays per 1,000 hours.
Exactly. And once you isolate those numbers with that mathematical certainty, you can plug them back into your CVP model. It takes the guesswork out of scaling up.
It really replaces panic with predictability.
It does.
Well, let's recap the journey we've been on today. We started by looking for the invisible levers that control a business's fate. We found the 4 dials: price, volume, variable costs, and fixed costs. We unpacked the counterintuitive superpower of pricing, where tweaking prices is a high-leverage tool, and why chasing volume by cutting prices is a death spiral.
We also explored how contribution and the margin of safety revealed the true health of a business.
We debated the risk and reward split between the unstoppable freight train of a high fixed cost company and the nimble bicycle of a low fixed cost company. And finally, we saw why the relevant range keeps accountants sane in a messy reality.
Ultimately, whether you are running a tech startup, managing a corporate division, or just trying to understand the economy, CVP analysis provides a literal map of how daily decisions translate into survival or ruin.
It really is the quiet engine of strategy. But I want to leave you, the listener, with a final provocative thought to ponder.
Okay, lay it on us.
We talked a lot about how this entire system relies heavily on the relevant range. The assumption that a business operates within a predictable window of normal operation.
The map we rely on, yeah.
But think about the era we live in right now. We are in an era of unprecedented global disruptions. Supply chain collapses, sudden pandemics, or overnight AI revolutions.
Oh yeah, black swan events.
Exactly. What happens to a business when a black swan event forces them entirely, violently outside their relevant range? When the neat linear assumptions break and the map no longer matches the territory at all? What is a manager's next move?
That is where the math ends and true leadership begins.
Something for you to think about next time you look at a business and wonder what's keeping it in the air. Thank you for joining us on this custom deep dive into the hidden mechanics of profit. Keep questioning the numbers and keep exploring.